following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and it has been a while since we've heard that theme music, but it is time once again for Volatility Views, your source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am very excited to once again bring together the old Volatility Views panel. It's been too long. So all of us here on the panel, we're shaking off the cobwebs and we're getting ready to dive deep, deep into the heart of volatility. Joining me on the Volatility Views panel is, of course, my boon companion, the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Mr. Schlesinger, it has been far too long, sir.
Well, that's for sure, and I hope that our listeners are enjoying a leisurely summer, perhaps have taken a little time for vacation, just as we kicked back a little bit here, but it's great to be back, and we look forward to doing today's show and another one at around expiration time in August before we get back to our weekly routine, which should certainly take place long around the Friday after the Labor Day weekend. So it's great to be back, and I'm happy to be here.
Yeah, no, a lot of our listeners have been champing at the bit, writing in saying, when you coming back, when you coming back? So it's nice to finally have a new live show for them. Not that it hasn't been fun putting out some of the best of shows for them. I know we've gained an audience since we launched the show, so I'm sure a lot of them haven't had a chance to listen to some of our greatest hits, like the show we did with Larry McMillan or the shows we did on Volatility Skew or whatever the case may be. So it was fun to put a few of those up there for our listeners as well. But it's much better to be back live and in person. Speaking of live and in person, we are also joined here on the Volatility Views panel by our Volatility Pit reporter, the man from the pit himself, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, long time no talk, sir. How are you doing?
I'm doing good. You know, every time you say the yin to my yang, I keep hoping someday it'll be me, and then my heart just breaks a little bit every time you say that.
Don got in there first with the yin to my yang, but
I've had an empty since we took a little break. I've had an empty hole in my heart for vol views that I've had to fill with Doritos.
That's why you ballooned 200 pounds since our last show. Now I understand. You're filling the void that was Volatility Views. I understand completely. Well, let's dive in. Let's see if we can fill that void ourselves with a long-awaited and much-anticipated volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. And in case you're just joining us for the first time, or you've forgotten because it's been so long, this is, of course, the portion of the show where we typically look back on the week's worth of volatility action. But since we've been gone for quite a while, well longer than a week, and also because we're recording this on a kind of an odd day for us on a Tuesday, sort of midweek, as opposed to the end of the week when we usually do, we're going to have a little bit different perspective in this episode's volatility review, we're going to have probably more of a longer-reaching perspective because a lot has happened in the world of volatility since the last time we spoke. We've seen VIX on quite the little roller coaster south of the 20 handle for the most part, but an interesting roller coaster ride it's been on nonetheless. So, Mark, why don't we start there then with the VIX? Let's look back a bit. I know it's been a while, so you may have to dust off your rearview mirror a bit, but let's look back at some of the trends and overall action we've seen since the last time we've convened here on Volatility Views.
Been a lot of downside pressure. We've seen VIX get lower and lower and lower and hitting lower lows. I mean, I thought there was a chance that we were going to see VIX break 14. We saw VXX and XIV swap places, so for a brief period, VXX was cheaper than XIV. And really, I think the real interesting, since we left, really, it's just been down, down, down until this week. And maybe they knew that vol views were starting again, and so they decided to pop the VIX again. But
give us something to talk about.
We actually saw a major overreaction of volatility. The market opened up about 25 handles with the VIX up, near 5 points. A massive move, especially considering we were trading around 15 before we saw kind of the VIX give away all, a chunk of it. And here we are today. The VIX is up about $1.25. It's interesting. We're lower than where we opened yesterday, but the VIX is actually lower than where we opened up yesterday as well. So, it just goes to show you that I don't think that we're going to be heading for a VIX of 30 or whatever, but on Monday there was a real chance that if we'd gotten a little push lower, we could have seen the VIX really take off. And one of the things I always say, and you guys can disagree with me if you want, is volatility begets volatility. And lack of volatility begets lack of volatility without some sort of major push. And there was a chance that I thought yesterday could be that push, but it was not. We bounced back, only gave up about 12 handles, and here we are today down 15 handles, but the VIX is still below 20. And until we see some sort of evidence that things are actually going to blow up in Europe, even with the euro now trading right at $1.20 relative to the dollar, I don't think that you're going to see the VIX really heading toward that exponentially high level. So it's interesting. The most interesting week we've had is, of course, the week that we're filming Volatility Views. So it just goes to show you that the market waits for Don and I.
It's interesting. If there's one theme I think that could be superimposed on VIX since the last time we convened, it probably is underperformance. The VIX has had many opportunities to pop, and many times when I think you and I both thought VIX was going to have a little bit more oomph than it did, or a little more action in the futures than we were going to see. It seems like every time going into weekends, going into the holiday, people took every opportunity they could to take VIX off the table, to sell VIX premium, and kind of keep VIX underperforming. And we did see, you're right, a good pop yesterday given this news of the Eurozone, but it certainly didn't go off to the races like I think a lot of people expected it to do given the news. And it is kind of weird because, I think maybe we joked about this a little bit on the option block yesterday, that maybe it's been so quiet in the Eurozone for a couple of weeks that people kind of grew complacent. And then all of a sudden when this news came out of Spain again, which was essentially par for the course for the most part, it wasn't exactly surprising news. And also the news out of Greece, that people all somewhat overreacted. And yet we didn't see the VIX. It bounced pretty strongly, but we didn't see that beginning of the new trend to the upside I think a lot of people might have expected. Don, is that kind of what you saw too in VIX land?
Yeah, I mean, the moves have certainly not been dramatic, to say the least. And the fact that as the market sells off, you've got this increase in VIX the last couple of days is surely not unexpected. But as Mark pointed out, it is nothing dramatic. We were in the mid-16s a couple of days ago. Now we're flirting with 20, just below it, 19.9 or so. And whereas that's a couple of handles increase, again, it's nothing that would smell of any kind of panic or tremendous unrest. So I think that you still have a little bit of the summer doldrums and the fact that absent any kind of really catastrophic news, you're unlikely to see any meteoric rise in VIX.
Yeah, if we continue this trajectory and there's no more shocking news to the rest of the week coming out of the Eurozone, I wouldn't be surprised going into the weekend to see people start taking VIX down a bit again. We've seen continued reluctance upon people to own a lot of premium going into weekends, regardless of what they've learned from recent years, that there is a lot of weekend risk out there. They still don't want to really carry this stuff, it seems like. So I wouldn't be surprised if we just stay par for the course the rest of the week, if VIX continues to come off after this early pop to the upside. Speaking of pops to the upside, this is actually a fortuitous day for us to be recording because from a NASDAQ vol perspective, one of the big drivers, the big agents of change in NASDAQ vol land is going to be reporting after the bell today. I know I'm talking about Apple, and I know Don repeatedly takes umbrage at my referrals to Apple as its own index and as the main driver of NASDAQ vol, or even calling NASDAQ Apple Plus sometimes. But there certainly does seem to be that belief out there. So this isn't a good day to discuss a NASDAQ vol and what we've been seeing in NASDAQ in general. So Don, what are the trends you've been seeing across the board in NASDAQ vol since we last spoke?
Well, it is kind of interesting because I kind of reviewed my notes. It's been a long time, but we actually recorded our last show on Friday, the 15th of June. So we would have had volatility information through the close of June the 14th. And at that particular time, we were looking at 1 month or 21-day NASDAQ, that's historical or realized volatility, of about 20.7. And you might recall that when we were doing our crystal ball, we were talking about the fact that we had been inching up and kind of just on a gentle upward slope. And when I was asked for predictions, I recall saying that I can't think of any good reason why this wouldn't continue for a while. And although we didn't come back for a few weeks, in fact, that's exactly what happened. And we kind of drifted in the realized volatility space up to a high of about 23.5. But we have since come in substantially from that point. And as we sit today, looking at realized volatility of the 1 month variety as of the close last night, NASDAQ has settled in at about 19.2. So it's not only off of its highs since we did our last show, but it's actually almost 1.5 points lower than when we left our listeners. And not surprisingly, S&P realized volatility has followed a similar path. It was about 17.7 at our last show and then drifted all the way up to 20.3, only to fall back down. And as of last night's close, 1 month historical volatility on the S&P is actually 14.8. So it's rather low. And of course, when you take a look at VIX in the 19 handle now, you once again have that risk premium of somewhat around 5 percentage points with the spread between implied and realized volatility.
You know, NASDAQ seems to have been the vanguard of many of the moves we've seen of late, where S&P will be down half, maybe 3/4 of a point on the day, or a percentage point on the day, and then NASDAQ will be down a full point or more. And actually today we're seeing NASDAQ being the laggard for a change. Most of the major indices, as we're recording this, are off over 1% on the day, and NASDAQ is off about 0.8% on the day. So NASDAQ underperforming the move on the day for a change. And you'd think, Don, as well, you know, we joke about Apple's impact, but leading into the big Apple announcement today, that would add a little bit more froth to the mixture for the past week or so. You know, we always talk about the ramp up leading into Apple earnings, both from an underlying movement perspective and, of course, a volatility perspective. Seems like we didn't see that much of the Apple effect going into earnings this cycle.
No, and of course, again, you know, that kind of anticipation where volatility can inch higher is of the implied nature. So you kind of have to look at NASDAQ VIX to see whether or not it's being reflected in the options prices, whereas some of the comments that I just made reflect more on the realized volatility. So there, until something actually happens and the earnings come out and we do or don't have significant movement.
All right. Thank you for that, Don. And with that, we're going to close out our volatility review and dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. This is, of course, where we dive into the weeds from a volatility perspective and talk about a lot of interesting discussion topics that are interesting to us from a volatility perspective or have been catching our eye since the last show. And it has been so long since the last show, Don, that I almost don't even know where to begin. There's so much material to dive into, so many things that we've wanted to talk about on past shows and haven't had a chance to, so many things people are writing in to ask about. There's a lot of topics that we could dive into, but I know on some of the recent shows, we've hit on a bit about variance swaps, the OTC variance and vol swap market, how that works. We even had some guests on recently to discuss the vagaries of OTC variance and vol swap pricing, an obtuse process, to say the least. But we never actually got around to diving into some of those underlying calculations that go into some of these behemoths that are known as variance swaps out there and why some of these prices from a notional perspective are just so unwieldy. I can hear you champing at the bit over there. I know you've been looking to dive into this topic for a while. Since we've been off for so long, Don, maybe I'll let you just dive right into it and you can cut your teeth again.
Well, it's actually very timely, at least for us at the Volatility Exchange, because we have actually embarked on quite an interesting academic project with our colleagues and friends at IIT under the direction of Professor Bilson, who was a guest on our show a while back. And we have actually...
I remember him. You and I had a nice discussion. Right. You know, after the fact, I went over and taught a class at IIT.
Oh, that's great.
Yeah, it was fun. I just went in and met with some students, and it was a lot of fun kind of trying to explain to them the difference between realized and implied, and, how we measure the risks. And it was, there really are, if you're interested in learning how to trade, it's a really good academic approach to how market makers kind of think. They don't have 100% right. You wouldn't expect them to, but they've got a really good start and one of the better programs I've seen.
It's not surprising that being so close to Chicago and downtown Chicago and the trading floors, that some of that would have rubbed off on their finance program over there. In fact, I'd be surprised if it hadn't.
So we've got a couple of bright students who have been willing to do some research for us because Bob Krause and I are particularly interested in trying to create studies as to the efficiency of vol contracts, realized volatility futures contracts, and their ability to hedge both equity portfolios, options, book exposure, and obviously research has been done somewhat in the area of VIX products, but it is less likely to have ever been done with realized volatility products because they didn't exist over a long period of time. And basically, it's what we're bringing to the marketplace. So lacking empirical data and historical prices for what would be the equivalent of a vol contract, which would be a volatility swap, if you will, we've been trying to apply some of the theory and the math that drives variance swaps and the relationship between their prices and volatility swap prices in an effort to build a kind of a database, if you will, that would replicate theoretically what historical vol contract prices would have been over a long period of time looking backward had such an instrument been trading. So along the way, and in doing some of the research and reviewing a lot of the academic papers, it seemed to me that it might be fun to review briefly some of the ideas behind how variance swaps are actually quoted in the marketplace, priced, what the difference is between the strike of a variance swap and a volatility swap, and go over some of the fundamental ideas. I might even suggest to listeners, I know if you're out and about or you're listening in your car, that's not quite the time to take notes, but if others are sitting around at a desk or have a little paper and pencil, it might actually be easier to follow some of these points if you're able to scribble a little bit and write down a few numbers and a few equations.
We often counsel our listeners to pull over to the side of the road when they're listening to our program, just to avoid all the many shocks to their system that come when listening to our shows, but also to take a nice note every now and then to be able to follow the discussion a little longer. So if you are driving, by all means, pull over to the side of the road. We don't want any distracted driving accidents while people are listening.
One of the first things you see if you ever see a term sheet or you go to an investment bank or a swap dealer and you ask for a quote of a variance swap, one of the first things that is discussed is whether or not your actual payoff in terms of profit and loss from movement of variance will be expressed as a variance notional amount, or a related concept, which is called a vega notional amount. And so the idea here is a fairly simple one. Variance is the square of volatility. And so if volatility is around 20% and we quote a volatility move from 20 to 21 or to 25 or whatever, a lot of people are comfortable with that, and they basically are accustomed to quoting things in volatility terms. And so even if you're trading variance, which is the square of volatility, we don't often talk a lot about, variance is 400 right now, and it might go up to 625. But that would be the analogous move from a volatility move of 20 to 25. And so when you actually stipulate with a swaps dealer what a payoff might be in terms of variance notional, you would be quoting those much higher numbers. In other words, if variance went from 400 to 625, that would be 225 variance points. And you might say, well, we're going to have $1,000 per variance notional. So, that could be a difference of, let us say, $225,000. Well, that's well and good. And you are trading the squared number, you are trading a variance, but even though you are, it has become customary to actually quote the payoff as a reference and not as a precise dollar value, but just something that some people find it easier to wrap their minds around, what's called the vega notional. And that would simply be to kind of be more comfortable speaking in volatility terms and to calculate what a payoff might be if volatility were to move, let us say, from 20 to 25. And obviously there you have 5 points. You don't have 225 points. And you might see some sort of a relationship there. So there's actually a formula. And the formula is that they often quote this vega notional as the variance notional multiplied by 2 times the strike price of the swap. So if you struck a deal, if you struck a swap as a starting point, as a reference point at a 400 variance, that would be a 20 volatility. So the strike price of a corresponding volatility concept would be 20. And at that particular point, if you multiply that by 2, and I'm going to explain why it turns out that way, you would get 40. And so instead of speaking about, we're going to pay off in $1,000 per variance point, you might reference something that people might feel more comfortable with and say we're going to pay off a $40,000 for each volatility point. Now, again, the important thing is that this is not a precise relationship, and therefore you're not doing a volatility swap, you're not doing a vol contract, you aren't going to actually be paid that way, but it's a way of expressing it. It's a way of referencing it so people can feel comfortable saying, oh, gee, I'll make or lose about $40,000 for each point that volatility moves, even though the actual final official payoff will be in variance terms and with that variance notional multiplier. So the reason that it's 2K, the reason that it's 2 times the strike, is because they want to get as close as possible to what the equivalence would be if, say, volatility moved 1 point. So this is kind of where a little paper and pencil helps. If the strike price is depicted or denoted by the letter K, and you said, well, that's volatility, what's variance? Variance would be K squared, which we just discussed. But what if volatility moved up 1 point? What if it moved to K plus 1? Well, then the variance would be the expression K plus 1 squared, or raised to the second power. And if all our listeners remember from their binomial expansions from their good old algebra days back in high school, if you take the expression K plus 1 and you square it, you get K squared plus 2K, you get that middle term, plus 1. So as you get that 1 point move from 20 to 21, or K to K plus 1, variance moves from K squared to K squared plus 2K plus 1. Okay? Now, what's the payoff going to be? Well, the payoff is the difference between the final variance and the original variance, the strike price. You get paid notional, the difference between the two. So if my ending point is K squared plus 2K plus 1, and I subtract the starting point of K squared, the K squares drop out, and I'm left with 2K plus 1. Well, that's awfully close to that 2K multiplier that I mentioned just a moment ago. And when volatility is something like 20 and 2K is 40, the difference between 40 or the exact number, which is 2K plus 1 or 41, hardly matters very much. So this is why the math turns out such that you basically have that relationship where Vega notional is expressed as 2 times the strike price, 2K, multiplied by the variance notional. And it's so that if volatility were to move by approximately 1 point, you would have a pretty close relationship whether you expressed the payout in variance notional or in this Vega notional. And to give a numerical example, suppose we were at 20 and we moved to 21. Well, in variance terms, that would be moving from 400 to 441. And 2K, or 2 times the strike, 2 times 20 is 40, and there we are at 441, so we're only off by 1. If you drop down to 19, 19 squared is 361. That's 39 away from the 400 in the middle. And again, you're very, very close to that 2K. What then becomes extremely important with variance swaps and why they are priced differently from volatility swaps is the fact that as the move becomes more substantial, you start to lose the symmetrical payout that you would have for volatility, up 1 point, down 1 point, up 5 points, down 5 points. And as you start to get larger movement, this symmetrical payout to one side or the other starts to get away from you. So let's take an example where volatility is 20 and variance is 400, but let's move by 5 points rather than by just 1 point. Well, if volatility moves up to 25, the square of that is 625. If volatility moves down 5 points to 15, the square of that is 225. Well, now if you compare those two numbers to 400, you'll see that you're no longer quite as close to being the same. You start to lose the symmetry. 625 compared to 400 is a difference of 225 points. But 225 compared to 400 is a difference of only 175 points. And so we start to see this property, if you will, of variance payout, which is for an identical move up or down in volatility, you don't have the identical move up or down in variance. And in fact, clearly, you're making more to the upside than you're losing to the downside if you get the identical move in volatility points. The gain of 400 to 625 is substantially more than the loss of 400 to 225. So what we learn from that is that the payout for a variance swap is a curve. Because of the squared feature, the payout is exponential, whereas the payout for a volatility swap is linear. You go up 5 points, you make 5. You go down 5 points, you lose 5. Well, we just showed that that's not the case for the variance payout. And so what we have here is a difference between the potential that you can make as the buyer of a variance swap to the upside and to the downside. Well, that has to be factored into the pricing. And so because you have greater potential to the upside, if you have volatility go berserk all of a sudden, than what you would lose to the downside, it's mathematically always the case that a variance swap will be priced and struck at a slightly higher level than the corresponding volatility swap on the same day. And so the final piece of the puzzle becomes how much difference should there be between the pricing of the two different kinds of swaps? And that's where it gets a little bit dicey because, as listeners can understand, the more potential there is for a huge move in volatility, which would produce that asymmetric payout between upside variance and downside variance, the more your forecast would be for volatility to have a chance to really swing and to move around, the greater the difference should be between those two payouts. And so we actually refer to the volatility of volatility or the variance of variance to give us a clue as to how different those two pricings should be. I think it ought to be intuitive to our listeners, and they would understand that the more potential we have for volatility to really move around and have a huge movement, the more premium we're going to have to pay for a variance swap than we will for a volatility swap because of that asymmetrical payout and the chance that you can make more to the upside than you lose to the downside. So the last piece of the discussion has to do with this adjustment that we make from the price of a variance swap to the price of a volatility swap, which is less by a certain amount. And we refer to that as the convexity adjustment. Convexity having to do with the shape of the payout of the variance swap curve. It's kind of like convex down, where the payout for a volatility swap is a straight line. And there needs to be an adjustment to that curved function as opposed to the straight line function of the volatility swap. And so the greater we expect vol of vol or variance of variance to be, the greater that adjustment is, referred to as the convexity adjustment, in subtracting off a certain amount or a certain piece from a variance swap. So maybe on one day a variance swap is priced at 21.5 and a vol swap is at 20. but maybe another day, if I expect a tremendous amount of variability of volatility itself, I might price a variance swap at 22 or 22.5, while the corresponding volatility swap might be 20 or 20.5. So that's kind of like the final piece in the puzzle of how we relate volatility swaps to variance swaps and why there's a difference in the two prices.
Well, listeners, we promised you that we would dive back into the weeds, and we certainly did not disappoint. I know we've been toying with getting into some of those formulas in more detail on recent shows, and like I said, we had some guests recently. I forgot the episode number. We'll have to look it up for the show notes, where we had guests come on to describe some of their ideas for pricing those OTC variance swaps. And now you, the listener, have been given a full overview of some of the methodology and calculation that goes into those variance swaps and why they are such an unwieldy beast to price and to trade. As Don examples show, those prices can vary wildly with just a few ticks of the underlying vol points. So that makes them very interesting from a trading and from an analysis perspective, as you can see.
We've been asked more than once, and in fact, actually fairly recently in our discussions with various investment banks and potential investors in our volatility exchange. Sometimes they're a little bit leery, and they're saying, you know, the CBOE offered a variance product on realized variance, and it wasn't successful. So they kind of extrapolate into wondering whether some of that might carry over to the potential for success of a realized volatility contract. And among the many arguments that we make as to say why these are in fact different beasts, as you've mentioned, is the fact that, you know, if you're going to be a market maker for these variance swaps, and the public is the natural buy side and the market makers are often short this kind of exposure, then when the you-know-what hits the fan and we don't go from 20 to 25, but we go from 20 to, let us say, 60 on a volatility level, well, it's bad enough if you're a market maker in volatility and you lose from 20 to 60, a multiple of 3 times. The corresponding variances there are 20 squared, which is 400, or 60 squared, which is 3,600, and now the loss is 9 times the original value, which I guess if I were a market maker and taking any of these positions home, I'm not so sure how well I would sleep in the evening.
Yeah,
so
that gives getting run over a whole new meaning.
Absolutely.
Well, isn't that part of what happened with the whole TVIX problem? That, I mean, isn't some of this a little bit why Credit Suisse kind of got some trouble when vol was rallying and TVIX turned really hard to borrow? This similarly related, isn't that right, Mark?
Did they get caught up in the variance swaps? Is that what what priced them out of control?
They definitely decided they didn't want to be short something like 360 million Vega, and couldn't properly hedge it. And I think my understanding is they weren't carrying just VIX futures. They had some of these swaps on. They didn't price out properly or something.
I guess, you know, if you have that much size on and you're short that much Vega because you've created one of these monstrosity products that is just nothing but short Vega, it's going to be hard to go out in the listed world and get all the hedge that you need. So you probably do have to delve into the OTC world. And you're right, I hadn't heard that, but maybe that does make a lot of sense, that something like that would come back to bite them. Especially given these examples we just saw of these extreme notional prices and the swings they could cause just from a few ticks of volatility. All right, thank you for that, Don. And with that, we're going to close out our volatility viewpoint for this episode and dive right into our listener mailbag.
Listener mail. Listener mail. Listeners write in.
All right, and the mailbag is open once again here on Volatility Views, and this is, of course, a portion of the show where we like to let you, the listener, take the reins and run with the show for a bit. And the first question is actually a quick hit from Twitter via the user goes by the handle Texas T, must be an oil trader. And he writes in, "Hey Vol Views gang, which will we hit first, VIX of 40 or a VIX of 14?" It's an interesting question, nice little quick hit. I would have been much more tempted, had much more debate on this question if he had said VIX of 30 versus VIX of 14. But VIX of 40 versus 14, given everything we just said, everything we talked about at the top of the show with the propensity for VIX to underperform of late, regardless of what's going on, and so seeing the VIX really come in aggressively towards the end of the weeks and even going into holidays and things like that, I could see VIX popping. VIX could get into the high 20s, maybe even over 30, but I don't see it hitting 40 before we hit 14. I see it's much more likely, given the scenarios we've seen right now, for VIX to sell off more aggressively or drift perhaps down to 14 than it is to pop. Because people forget 40 is a significant level in the VIX. You know, we've seen some crazy levels of late, so people's frame of reference for the VIX is a little bit skewed. But historically, 40 is an absurd level for the VIX. Mark, what do you say about this either-or question?
14. 14, for sure.
It's a pretty easy one for you. Don, I'll let you weigh in as well.
Does the writer understand how difficult and rare a 40 VIX actually is?
I don't think so. That's why I was talking about the frame of reference, you know, and how absurd that level really is and how difficult it is for it to hit that level on a regular basis.
Certainly a lot easier to get to than 40, so I'm just going to go with the stats.
Don, I'm assuming you fall into the same camp?
Well, I certainly would. I mean, we're at 19 and change now, but when this question was asked, we could have just as well been at 16 or so. And so it's not much of a fair fight, starting at that level and saying, do you think we might go 2 points lower before we go some 24 points higher? Having said that, you know, stranger things have happened, because if there is some sort of cataclysmic event, we know that volatility can spike dramatically and in quite a hurry. And sure, we have seen levels like 40. In order to go from about 20 to 14, what you really need is either a sustained up movement and a really strong bull market for a while, or at the very least, you know, almost nothing going on, so that things get so boring that volatility starts to come in for that reason. So the only argument, and I'm not making it, for the high upside number is that, you know, the market often makes precipitous moves to the downside, which could prompt that kind of level of volatility. It doesn't usually make precipitous moves to the upside. So to get to that 14, you need a kind of a more sustained long-term upward trend that, you know, may or may not be the reference for it right now with stuff going on in Europe and what have you. But surely if someone were going to make odds on this, they'd have to make 14 the favorite.
Yes, the numbers don't lie, and it's hard to argue with the math on this one that 14 is certainly a much more likely outcome than 40. So sorry about that, Texas T. I'm not sure which way you were leaning, or perhaps you're happy. Maybe you're leaning to the 14 side of the fence along with the rest of us. And the next question comes in here via Facebook from Alex K. writing in from Tucson. And he asks, why don't more brokerage firms allow you to quote options by volatility levels instead of price or premium levels? You think this would be a very desirable feature, particularly to the type of educated clientele that listens to a show like Volatility Views? That's certainly a desirable clientele for a broker. I know I would certainly like that feature. Can you guys weigh in on this and hopefully help me spread the word for this feature among the online brokerage firms? And then he writes, on a side note, I can't wait for Volatility Views to get back to its regular schedule. I never thought I would be this excited for the end of summer. Well, we're glad we can keep you excited, and we hope this live show and the one we do next month are enough to keep you satiated until we return there in early September. But as for the rest of your question here, Alex K., it's an interesting one, and it's one we've actually heard quite a bit from some of the more sophisticated users out there, because as we've said a million times on this show in the past, most sophisticated options traders really think of themselves first and foremost as volatility traders as opposed to option traders. So they're looking and gauging their trades far more off vol levels than they are just price or premium level. So it would be great to see a lot more brokers offer that sort of functionality. There are a handful that do. A lot of the ones I've seen attempt it, it's been a very half-baked type of feature because price is a relatively stable quantity. It's easy to pull that from quotes and be able to disseminate that and execute trades off that. Volatility is obviously a variable of another formula, so that allows a certain amount of fudge factor in there, and being able to execute off that reliably has proven to be a bit of a hurdle for a lot of firms. So a lot of firms will disseminate volatility numbers for you and allow you to see that number prominently when you're executing and seeing exactly, if you execute a, let's say, $4, what implied volatility level that is, and perhaps even a realized vol level. There aren't many yet who've really mastered a great functionality for executing across volatility levels. Mark or Don, you guys have anything you want to add to that?
I think one of the major points is that you mentioned the concept of the model factor. As listeners know, you can't calculate implied volatility. There's no closed form solution for it in a formula. What you do is you back it out of the options pricing model by tricking it into using the current option price as one of the inputs and kind of trading and getting implied volatility as the output instead of the standard way of doing it, which is put in a volatility estimate and get a price. So that being the case, when you're going to quote an option price as actually a volatility level or an implied volatility, everybody has to agree on all the parameters of the model, including things like the current risk-free rate or the dividends that are about to be paid for an underlying stock or for the S&P 500 if you're quoting an index or something like that. And although most of these things are fairly, common knowledge and people agree on them, at least in those terms, there can be some room for difference and even for using a different model, which would lead to a different expression of implied volatility. So that makes the whole thing just a little bit more complicated.
Yes, it's a little bit more wonky to get to that number, and having to back it out makes it hard to execute on it.
I mean, Mark, the major flaw in this guy's thinking is the assumption that the brokerage firms spend any time or effort into their volatilities. They all stink, and they're all terrible, and none of them really do, the only ones that are even close are like live vol. But, Thinkorswim and IB and all of the major brokers, they can't even take the time to calculate the proper cost of carry for the SPX. Do you really want to use them to quote vol? And the answer is no. So really, start with, hey, how about we encourage them to get good vols, and then let's move from there. Because right now, all they're doing is spitting out crap.
This is a nice idea, and I would like to live in a world where this was possible. But right now, I think, as Mark just alluded to, there's still a few hurdles to be overcome before we can get to a level where this vol is an easily accessible and easily executable parameter for these brokerage firms to disseminate and trade off of. So we're with you here, Alex K. We agree with you. We just don't see that happening anytime soon for all the reasons we just outlined. And we'll finish it up here with an international email coming in from Alessandro Ropa out of Barcelona in Spain, where all the trouble is coming from. Alessandro, I have a feeling all of this Eurozone trouble is all your fault, sir. But
I don't even care what the question is. I'm just terribly impressed that we got listeners in Barcelona and that they're sending in questions. That's terrific.
It certainly makes you think twice about what you're saying into the microphone when you realize our reach is that vast. But,
international reach.
Yes, indeed. I told you, Don, I'd make you a star. See? Against your will, but still. And Alessandro writes, does the Volatility Views team feel that the new method for listing weeklies will lead to a reduced volatility of volatility in those products? Thank you very much for your fine program. Well, Alessandro, you're welcome for the program. And just a quick recap for our listeners who are not familiar with what Alessandro is referring to, we've discussed many times on this show how the equity options world has really taken a very limited view of the weekly options and listing them essentially one week to the next and incentivizing this flurry of selling activity that we've seen in the equity options and the weeklies, whereas the futures options world is taking a much more nuanced approach of listing the entire strip, the entire month's worth of weeklies at one time, allowing you to trade back and forth and execute a lot more interesting and nuanced strategies. And what we've seen now is that the equity options world is adopting a similar approach, and that's what Alessandro is referring to. Personally, I think it might have that effect, because right now what we've seen, like I said, is just this flurry of just one-sided paper flowing into this front week of listed contracts, and then it repeats again every cycle. And at least my hope is that by listing this full months of contracts, we might see a little bit, at least, of a migration of that liquidity from the front week and into the second, maybe third week of contracts, and allowing people to trade spreads back and forth and do ratios and some very short-term calendars. And by migrating that liquidity, we might see a bit of an impact on the vol of that front week contract. But we also might see, I think, a lot more nuanced trading and is frankly just better paper flow and better liquidity overall by spreading this liquidity out across the front months. I'm not saying that this mad rush to sell premium is going to go away in the front week, but at the very least we might see that mitigated by some other activity going on in, let's say, week 2 or even week 3. Mark, would you concur with that?
Yeah, and more importantly, at least you'll get some real logic to how the options decay, which makes them more usable by institutions. One of the things that stops institutions from using weeklies as they were listed is the herky-jerky nature in which they would decay. Listing them out 4 months 4 weeks at a time allows for a much smoother decay, much more thoughtful decay, and more similar to how a normal option should act. I think there'll be some interesting side effects. Like I said, I think it's going to allow the spreading it's going to really allow for us to really trade specific events and see where risk is interpreted to be highest and lowest. I think it will smooth out some of the, it may actually smooth out the VIX a little bit. And I think there's a lot of other things that it could potentially do. I got in Mark, you'll love this. I got in another argument with a tech guy about how, I think weeklies, are going to affect some vol indexes because of the fact that paper moves into those weeklies. And the guy said, well, don't you know that the monthly contract includes the vol of that one day that has the event? To which he's correct theoretically, but any type of person that thinks that ahead of a major event that paper is logical and spreads don't get out of whack and stay out of whack for some time, especially ahead of major events or in the middle of a panic, I think is missing something, because, I think that one of the nice things about these weeklies is it'll put some of the VIX itself in a little bit of a methadone clinic and maybe smooth it out a little bit.
It's all about the paper flow, baby, and hopefully this will add to some more logical paper flow going forward. Don, anything to add for our international listener here?
No, not a great deal. I think you've summed it up. Just to say that, in general, when you're talking about products and you're talking about vol or spikes in volatility itself and of the underlying, the more that you can offer a smooth kind of a flow with the increase in liquidity and a greater potential for trading on a very smooth and regular basis, the more likely you are to mitigate these kinds of irregularities. Not eliminate them altogether, as Mark has said, but simply smooth out the flow, which I think is relative to the question.
All right, thank you for writing in, Alessandro. Unfortunately, that's all the time we have for the mailbag this episode. So if you wrote in, hopefully we'll get to you on our next live show. But keep sending those questions in. We love to hear from you. But right now we're going to dive right into our Crystal Ball segment.
And now we take a look at the Crystal Ball.
All right, and that sad little tune means it's time for our final segment, the Crystal Ball segment. And guys, this is the challenging one because we're not simply looking forward a week as we usually are, but we're looking deep into the waters to see what the future holds for a month out from a volatility perspective. So, Mark, why don't we let you go first, and let's talk about VIX, not just a week out, but till the next show, so a good month away.
Well, we're right at 19.69 right now, which is right at the mean. Well, one thing people aren't aware is that the mode the number of occurrences below the mean and the number of occurrences above the mean are very different. I continue to think that unless we see a major blow up in a serious blow up in Europe, that we're heading right back down to 16. So I'm a seller. That's just me. The one interesting one, and I wish we didn't really talk about this, but Euro FX option vol is really low, and there are a few other things that are, and I think that's where potentially, I think that if you were looking to buy vol, I think buying 10.5% implied volatility in FXC or in the Merck FX options might be an interesting purchase, with potentially the ability of FX to really take a dive and or really snap back if we get some major central bank intervention. Thoughts on that one, Don?
You actually have the 1 month Euro vol level right now just below 11, but the 3 month level in realized volatility is below 9 at 8.86. And interestingly, we talked earlier about vol of vol. For the 1 month, which is always a high number, you've got volatility of the euro at 119. So you have tremendous potential for movement there. And again, when you're talking about a relatively low number like 9 or 10 or 11, the chance for a pop into 12, 13, 14, especially with that kind of vol, is surely very great. Insofar as NASDAQ is concerned, we'll talk a little bit about that. I think that I'm probably in Mark's camp that the coming month until we speak to our listeners again is really traditionally a time, July 24th to third week in August, where you really have the potential for those summer doldrums with a lot of people away on vacation. And of course, not to say that world events don't constantly keep us on our toes, but, failing something dramatic again coming out of Europe, this is traditionally a time of year where kind of volatility goes on hiatus for a while. So I'd probably at this point be in agreement with Mark that we're more likely to come in from where we are now, and we'll check back with our listeners in the middle of August than we are to go higher.
Hence, all of us leaning towards the 14 as opposed to the 40 on that listener mail question. But yes, it certainly seems like Eurozone notwithstanding for a little pop here or there, we definitely might be heading into some doldrums for the summer. So listeners, there you have it. Sell NASDAQ vol, sell VIX, and perhaps buy some Euro vol, and you'll be sitting pretty by next show. So unfortunately, that's going to do it for the Crystal Ball and also for this episode of Volatility Views. Unfortunately, you have to wait another month to hear from us again, listeners. But in the meantime, you'll have some great best-of segments to look forward to. And before we go, my cohorts here on the Volatility Views panel would like to give you an update on the various things that they're working on that might be of interest to you. Starting off with you, Mr. Sebastian, what is coming out in option pitland that may interest our Volatility Views listeners?
I want to make sure everybody that's listening is locked and read the Option Traders Hedge Fund, my book that came out last month. The support's been great. If you haven't read it, you should. It's worth the read, and comes with a free month of my Option Pit Live service, which I charge $125 for. So, you get 3 times the value of the book just in the back of the book. So if you haven't read the book, go out and get it, and give it a read. I think there's some good info in there.
A valuable pack-in that Mark has thrown in for you Volatility Views listeners. So take advantage of that deal. Surf on over to Amazon and search for Mark Sebastian, Sebastian, and you'll find his book there, as well as a few other interesting things that have nothing to do with him, but are still very interesting. And Don, before we go, what give our listeners a bit of a preview of what's coming up over at volex.us, as well as what's coming up in Volex land for the next few months.
We're really active despite the summer months with our talks and negotiations, both with exchanges and potential partnerships with major investment banks. And those talks have been proceeding very, very nicely and at the highest levels. So we're very optimistic that everything is moving in the right direction and that we will be able to proceed with bringing out not just a single vol contract on the NASDAQ, but hopefully sequentially many more to come. Over at the website, Bob and I and our webmaster, Norm Wattenberger, have been kind of working furiously these past weeks to really update all of the content, to add several features. We now have a real-time concept for how we would calculate realized volatility even intraday, and we describe the formula and how we plan to do that once the products are up and trading. So if in fact you haven't looked around the website for this past month or so, go back and have a look. I think you'll like the way it's set up and some of the added features that we've provided,
including that great list of our Volatility Views episodes, which breaks the show down not just by episode number, but also by guest and subject matter. So you can go in and check it out and see if there's a particular guest or topic that you haven't heard that might interest you and listen to it right from the page. So I encourage all of our listeners to head over to volex.us and check that out for themselves. And unfortunately, like we said, that is going to do it for the next month here for the Volatility Views panel. But of course, all of us here want to thank all of you for downloading and streaming and subscribing to the show, including you, Alessandro, way out there in Spain, and for making this show such a success. And we'll see you next month right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.